Hello and welcome to this edition of Women's Wednesday. I'm Kavita Thapliyal, and today we're going to talk about how women can build up their confidence towards investments and how can they take steps towards securing their financial future. I have with me Suranjana Borthakur, Head of Distribution, Mid Asset Investment Managers India. Hi and welcome to this edition of Women's Wednesday.
Thank you.
Yeah, talking about building women confidence as far as their investment goes, because building confidence for money and taking care of money is already inherited. I mean, that's by default that women have. But then when we talk about confidence towards investment, what do we actually mean by this?
I think confidence in investing comes with a mindset change.
Sure.
It's always perceived that the financial management or taking care of your finances is always a man's job.
Yeah.
It is a change that is happening. Number of women investors are increasing, but you will see a lot of times that there are women investors jinke naam pe there is an investment that's there,
but they don't
even know. They don't even know that the investment is there. They don't know which instrument it's invested in, and that is something that needs to change. It is a mindset change that has to happen. But I think over a period, it is about the journey, how you change this entire mindset and then step into the investing journey.
Process,
and it will happen slow and steady, but it's about taking control of what you can do. And again, in the journey, if you see, starting with small things, starting with maybe just a commitment towards an SIP that you start initially, and then you go into lump sum investment, then you go into investing into different portfolios. It can also start with maybe like fixed income instruments. In equity, you can start from like maybe something like a index products or an ETF product, which is just tracking the market. You start to understand the volatility of the market there.
Exactly, that's very important. You can start simple, you can start small, but understanding the nature of your investment instrument, I think that needs to be the homework or the groundwork that a woman investor needs to do.
Yeah, they have to understand, because see, if you do not, a lot of times people don't even understand the difference between like saving or investing. They just have money, like today I have 10,000 rupees. 5 years down the line, that 10,000 rupees will not be worth this 10,000 rupees. But people don't plan well for it, and they think that I have savings. But is the savings working for you? Is it giving you the returns that you're expecting it to give over a period?
So how do you know that the saving is working for you? And when we talk about earning returns, what is the benchmark to which we are comparing these returns then?
So it depends on what kind of instrument you're investing into, right? Let's say if you have something like just lying in a fixed deposit, then it can be earning you just about a 6% return, which can maybe just like a 1 lakh rupees in a 10-year period will become a 1.8, 1.9 lakh rupees. But if you're investing in even a debt mutual fund, you may be able to earn about 8-9% returns.
So anything that's inflation beating should be your target?
Yeah, inflation beating should definitely be your target. But it should not just be in fixed income instruments, because you will have to make money. See, equity has the potential to actually give you that gains, which is the multiplier impact or the compounding that we talk about, is something that can actually happen more through the equity instruments, because what you can earn there in terms of the base you create and then the compounding that impacts is not possible in a fixed income side.
But there's risk also in equity, right? How do we understand this risk? Because see, we can start simple, we can start small, but we cannot learn without doing mistake. Right? So how do we understand equity then in this way?
So I think anything that you are starting new, you should be ready to make a little mistake. If you don't make a mistake, how will you know? How will you understand? A lot of times I'll tell you what happens. People are investing as per their neighbor's risk. Because what they will do is somebody will give them a recommendation that this is a very good fund or this is a very good stock. Invest in it. So they will go by their risk appetite, and when the correction in the market actually happens, they realize that they were never ready to move, lose this money even if for a shorter period of time. Maybe their time frame was not that 15 years that the other person had. Maybe their time frame was just 2 years. So that realization can come only after you dip your toe.
Yeah.
After you actually, if you straight away dive in and put all your money into, in a market like this today, when things have been looking very good. Right now there are some corrections, but last 2 years have been looking extremely good for the market, right? So which is where what happens is suddenly everybody thinks I can make money and I don't need anybody's help because I know how to make money. But once you actually see the corrections coming in and you actually see your portfolio coming down, you start seeing that there are, that this is not what you expected out of what, your investment is. That's when you suddenly start to panic. But you will not panic if you have assessed this risk. If you have understood that yes, with equity investing, there is a volatility that will come. But over a longer period, markets have given decent returns. It's just about staying committed. But again, more often than not, people will just take a call because again, somebody might have just told them that, okay, this is a bad time, markets are correcting, why don't you pull out your money? So you'll just pull out your money without giving it a thought that whether you needed that money or not. In Indian markets today, maybe the best time to invest is when you have the money and best time to take it out is when you need the money. So we have to understand this difference.
So which means that you need to ask questions and ask the right questions.
Yes.
Right? So what would that be? I mean, apart from asking how much return would I earn and for how long I need to stay invested, what should be a pattern of your questionnaire when you are putting your hard-earned money into any investment instrument?
Yeah. See, the first thing is, why are you investing?
Why are you investing? True.
If you don't know why you're investing, you are just investing. You in your mind, you will think you're investing because of X reason, but you will never reach that goal at all because you have not planned well for it.
So you have a financial goal.
Financial goal. I would say that when you start off, small amounts, that you're investing, that's when you can do the investing on your own. I also feel that once you graduate to a certain amount, when you've created a certain corpus which you don't want to lose, you need an advisor also.
You need a professional help.
Because professional can tell you a very different perspective. I have seen people nowadays in the last couple of years also, if you see, because of the way markets have behaved, I mean post-COVID, there were a lot of people in our in our country who are now becoming the new rich, who will probably become the HNIs and ultra HNIs later. So they actually do not have the correct guidance. What they do is, if once they have money available, they'll start buying houses.
Yeah, a lot of them from tier 2 and tier 3 towns actually.
In fact, tier 1 town. So I know people who are like, friends who I know who have started to make good money.
But they're supposed to be the urban part of, urban investing part.
Urban, where they have not taken help is what I'm trying to say. So let's say they start investing in multiple real estate, which is maybe not required for them. It's like, I bought a house in Delhi, I bought a house in Bangalore, and then what? Like, where is the liquidity there?
There is no liquidity.
And for equity, they've just done few SIPs maybe, not invested enough in it. What is important is you do the allocation well. You invest in different asset classes, diversify your investments, do not put everything in one basket, do not understand which asset class has the potential to give you what returns. Volatility will be a part of everything.
Exactly.
But it's about riding the wave.
I mean, all of these investment instruments we're talking about have risk attached to it. Okay, for that matter, even real estate. If you have all your investment done over there, there is no liquidity. I mean, I know of cases when people were in dire need of money and they were not able to sell off their real estate.
Absolutely.
What's the point?
This has happened to many people. And in fact, if you get into a good project, great. If you get into a bad project, you can be stuck for ages. But nothing to take away from real estate as an asset class. I think every asset class has their place, but overexposure is something that we have to completely avoid, and which is where I think an advisor can help you in the journey, and they can actually give you a perspective which you might have not thought of. But when you look at the questions that you can ask when you're investing is, when you start with the why, you know where you want to get. When you know the where, like I said, there could be different pools. It is not one pool. You need to know that if you're investing into a certain asset class, a certain product, what is the time horizon that you should stay invested? are you investing because the returns in the last 1 year has been great, or are you investing because the long-term trend of the product has been great? Never look at short-term returns to determine how much exposure you need to take into a certain
I think the
product
new
or
type of
category.
investors are more towards just looking at to the past 1 year return instead of looking at the long term.
If you look at pre-COVID in the mutual fund industry, there were just about 2 crore folios that were there. Today, if you see, it's around 5 crore unique PANs basically, which are there. If you look at these 3 crore additional people, they have actually come post-COVID. So now what has happened is, once they've come post-COVID, a lot of people have done seen a one-sided market.
True.
So a lot of people have chased. Where you think small cap is done well, let's invest into small cap. You think thematic is done well, let's invest into thematic. I'm not saying these categories don't have a place in the portfolio, but if 70% of your portfolio becomes small cap fund because you think small cap is doing great, that will not do justice to where you want to reach.
Exactly.
So a lot of times you don't chase the herd. Don't just follow what everybody else is doing.
Exactly.
Do a proper assessment of why you would want to invest, where you would want to invest, what is your time horizon, and what is your risk-taking ability.
Right.
Can you really take that risk?
And start small. But
Start
then
small,
what about investors or women investors who think that you need a large chunk of money, to get good returns? Which is why I think most of them just don't land up starting their investment journey only because they think that we need to first collect good amount of corpus to invest.
Yeah, that is a very, very pertinent thing actually. I hear this from many people that I just don't have the money. Therefore, when I have the money, I will start investing.
Yeah, sure.
But it's about the journey. It's about staying invested for long term. Let me give you an example that if you invest just 7,000 rupees, let's say, for a month, every month, at the, let's say you are investing it in an equity mutual fund, which is giving you somewhere around 13% returns, and you invest it for a 30-year period, that 7,000 rupees per month can grow to 3 crores. And out of the 3 crores, the 25 lakhs or 26 lakhs is the investment. The rest of around 2.7, 2.8 crores is actually your gains. So imagine the gains that you can make if you stay committed for a longer period.
Sure.
It's also important that you increase your commitment over a period. So if you've started with 7,000, doesn't mean it remains 7 for the rest of its life. You have more earnings, you keep increasing it to 10, 15, 20, 25, whatever is your capability. But also planning smartly is something that you can do well, because when you are investing and you are investing for something as a solution, let's say you've taken a loan. I'll again give an example where let's say you have taken a loan of 1 crore home loan, let's say, which is about a 30-year time span where your rate of interest is around 8.5%. Now what happens is it accumulates to the monthly EMI is somewhere around 77,000. So your amount which accumulates for payment as interest becomes around 1.7 crores. And your principal is 1 crore, so 2.7 crores is the amount that you have to pay. Now that's 7,000 rupees SIP, which we talked about. Against the 76,000 EMI, just a 7,000 rupees SIP in that 30-year period can accumulate 3 crores. So you are not just paying the 2.7 crores, you have additional money left for whatever else that you would want to do. So when you plan well, you have the independence to actually think that, it's not an overwhelming thing that, oh, you have such a large amount to pay off. It actually becomes an easy option to pay off, such liabilities.
So one needs to really plan well, but before that, if you're just testing the depth of the waters, then maybe just start small. A very important piece of advice. But thank you so much for being a part of this interaction today. Thank you. And
Thank you.
It's a wrap on this edition of Women's Wednesday. Thank you so much for watching. Goodbye.
Thank you.